Time to start Chapter 10, Module 1. In this chapter, we'll see how standard costs are used by managers to control costs. Ready to start, Sketch?
Sure, let's do this!
Let's start with a definition. A standard is a benchmark or norm for measuring performance. In managerial accounting, two types of standards are commonly used by manufacturing, service, food, and not-for-profit organizations.
Price standards specify how much should be paid for each unit of the input. For example, a hospital has standard prices they expect to pay for food and laundry.
Quantity standards specify how much of an input should be used to make a product or provide a service. For example, a car repair company may set labor time standards for the completion of various repair jobs. Or fast food restaurants, like McDonald's, have very exacting standards for the amount of meat going into a sandwich.
Standards are the quantity and cost we expect to pay for materials, labor, and variable overhead when we make a product.
The standard price per unit for direct materials should reflect the final delivered cost of the materials, net of any discounts taken.
The standard quantity per unit for direct materials should reflect the amount of raw materials required for each unit of finished product, as well as an allowance for unavoidable waste, spoilage, and other normal inefficiencies. These are summarized on a bill of materials.
The standard rate per hour for direct labor includes not only wages earned, but also fringe benefits and other labor costs. Many companies prepare a single rate for all employees within a department that reflects the mix of wage rates earned.
The standard hours per unit reflects the labor hours required to complete one unit of product. Standards are usually determined by doing time and motion studies.
Price standard for variable manufacturing overhead comes from the variable portion of the predetermined overhead rate.
The quantity standard for variable manufacturing overhead is expressed in either direct labor hours or machine hours, depending on which is used as the allocation base in the predetermined overhead rate.
The standard cost card, or bill of materials, is a detailed listing of the standard amounts of direct materials, direct labor, and variable overhead resources that should go into a unit of production, multiplied by the standard price or rate that's been set for each of those inputs.
In this example, our standard bill of materials tells us that we should expect 3 pounds of material to be used at a cost of $4 per pound for a total cost of $12 for materials to make one finished product. Total cost to manufacture a single unit of product is expected to be $54.50.
Remember from Chapter 9 that activity variance helps us understand the impact of activity to the budget. Both the planning budget and the flexible budget are constructed at standard costs. Standard costs can be used to compute the activity and spending variances.
Spending variances are the variances between the flexible budget and actual results. Those can be broken down into price and quantity variances.
At current production levels, how much materials and labor should we have used, and what should the material and labor cost us? Differences between standard prices and actual prices, and standard quantities and actual quantities, are called variances. The act of computing and interpreting variances is called variance analysis.
A price variance is the difference between the actual price of a resource and its standard price, multiplied by the actual amount of the resource purchased.
A quantity variance is the difference between how much of a resource was actually used and how much should have been used, and is stated in cost using the standard price of the resource. Price and quantity standards are determined separately for two reasons. Different managers are usually responsible for buying and for using resources. For example, the purchasing manager is responsible for raw material purchase prices, and the production manager is responsible for the quantity of raw material used.
The buying and using of resources occur at different points in time. Raw material purchases may be held in inventory for several months before it is used in production. So when we go to use some material, it would be hard to figure out how much that specific material cost several months previous.
Price and quantity variances can be computed for all three variable cost elements: direct materials, direct labor, and variable manufacturing overhead. For direct materials, we call the two variances price and quantity variance.
For labor and overhead, the variances are called efficiency and rate variances.
The spending variance can be broken down into the following components. Remember that all these variances are based on actual production levels. The standard quantity and standard price, which is the same thing as a flexible budget, is compared to the actual quantity used at standard price to give us the quantity variance.
The actual quantity at standard price is compared to actual quantity at actual price to give us the price variance.
Remember that the quantity variance and price variance together make up the spending variance. The actual quantity represents the actual amount of direct materials, direct labor, and variable manufacturing overhead used. So if we're making hamburgers, this is the amount of beef or labor that we use to make our hamburgers.
The standard quantity represents the standard quantity allowed for the actual output of the period. This is the bill of materials, or the recipe if we are making hamburgers. It is how much material we should have used.
The actual price represents the actual amount paid for the input used.
The standard price represents the amount that should have been paid for the input used. Again, straight from the bill of materials. Let's talk about how to compute the direct materials price and quantity variances and explain their significance.
Let's take this example problem and solve for material price and quantity variances. Glacier Peak Outfitters has the following direct materials standard for the fiberfill in its mountain parka. 0.1 kilograms of fiberfill per parka at $5 per kilogram. Last month, 210 kilograms of fiberfill were purchased and used to make 2,000 parkas, and the material cost us a total of $1,029. We need to know 5 things. First, what's the current production level?
We made 2,000 parkas, so 2,000 units.
Good. Now, what's the standard quantity of material per parka, or how much material do we expect to use to make each parka?
I think it is 1/10 of a kilogram per parka.
Right. Now, how much is the standard price, or what do we expect to pay for the material?
Would that be $5 per kilogram?
Sure. Now, what's the actual amount of material used?
I think I'm getting this. It would be 210 kilograms.
You got it. Now, what did the material actually cost us?
The 210 kilograms of material cost $1,029.
Good job. Now, let's calculate our quantity and price variances. The first thing we do is set up our table headings. Actual quantity times actual price, actual quantity times standard price, and standard quantity times standard price. The current production was 2,000 units times the standard quantity of 0.1 kilograms. That gets us 200 kilograms. Then we multiply that by the standard price of $5 per kilogram to get $1,000. This is what the standard tells us our cost should be to make 2,000 parkas.
Actual quantity used was 210 kilograms, so we multiply that by the standard price of $5 per kilogram to give us $1,050.
The difference between the $1,000 and the $1,050 is called the material quantity variance. It's the difference between the quantity of materials used in production and the quantity that should have been used according to our standard. It's $50 unfavorable. The quantity variance is unfavorable because the actual quantity exceeds the standard quantity allowed by 10 kilograms.
Then, for actual quantity and actual price, we were given that as $1,029.
That's right. We don't need to break that down into quantity and unit price because we're given the total, which is all we really need. The difference between the $1,050 and the $1,029 is the material price variance. It's the difference between what is paid for a quantity of materials and what should have been paid according to our standards. You can see that it's $21 favorable. The price variance is favorable because the actual price was less than the standard price by 10 cents per kilogram. Remember that all this is at current production levels. So the 200 kilograms under the standard quantity times the standard price is from 2,000 parkas produced times the amount of fiber fill it should have taken, or 0.1 kilograms. You can either use the table that we just completed, or you can use these equations, which are the same thing as the table. Material price variance can be calculated by taking actual quantity times the difference between actual price and standard price.
Materials quantity variance can be computed by taking standard price times the difference between actual quantity and standard quantity.
Again, this is the same thing as the table, it's just in an equation format. Choose whichever method you feel most comfortable with to work these problems. Remember, the materials price variance is usually the purchasing manager's responsibility, and the materials quantity variance is usually the production manager's responsibility. The standard price is used to compute the quantity variance so that the production manager is not held responsible for the purchasing manager's performance. That's all for Chapter 10, Module 1. See you soon.